So you and I chatted a bit yesterday. You said the sanctions on Russia and the impact on the commodity market, that's been one of the major reasons for the downturn in the markets. Obviously, that conflict not easing up anytime soon. And those sanctions, no clarity on when they'll be lifted. You and I agreed on a term, commodity anxiety. That's what the market is dealing with right now. How long do you see that impacting the markets? And is there any relief for that?
Yeah, well, I agree. I think commodity anxiety is the root of most trepidation right now in the markets, and I think it could actually last for the rest of the year. There are segments of the commodities markets where, the United States and OPEC can have an impact on oil. We can have impacts on various metals, but there are some metals that we cannot impact where Russia or Ukraine are either the number one or the number two producers in the world. So you look, for example, at palladium or platinum, and the forecasts are well above, what is currently priced into the futures markets, which are already high. And that's really what's feeding a lot of this anxiety. And so you have two pieces. One is that high commodity prices could just take a chunk out of demand and really, really put the skids on this recovery that we've been having that's already been slowing down. The second is that it could actually create and force high inflation and force the Fed to be very aggressive. Neither of those is necessarily a good outcome.
Yeah, neon's another one of those commodities that comes from the region. Definitely is sourcing important for not only chips, but production of manufacturing equipment. I want to look ahead for a bit. We have CPI numbers coming up. Last read at 8%. A lot of forecasts that's going to tick up even higher. Is there a number that would actually calm the markets and make people feel more comfortable? Can the Fed do something to make us feel better about this inflation?
Well, so there's two pieces to that answer, Frank. The first is the current forecast for CPI for this year is 6.9%. So the bar is actually pretty high for us to try to get below that number. But I actually think it could remain high. Where I really think that all eyes are on the Fed. The Fed is right now forecast to take a move every single meeting for the rest of the year. Expectations of pushing the short end up to 2.5%. Given where the 10-year is right now, I would say that the bond market is positioning itself for that. But just one miss, if the Fed were to take one break, and you've heard actually commentary out of the Fed saying there is a difference between inflation that is the result of an overheating economy, inflation momentum, and wage inflation, and inflation that's driven by commodities prices. And what we don't want to do is we don't want to make the same mistake we made in the 70s, which actually drove us into stagflation.
Before we let you go, Gina, one other question about commodities. Oil, we saw the prices decline a bit on those China lockdowns. They're back up a bit. OPEC warning of tight supply. How do you see oil continuing to impact the markets?
The problem with oil is that we went into this year actually in a tight supply market. We had a whole lot of labor shortages, that we're holding over from the pandemic. And so it wasn't very easy to sort of just let loose the production spigot. And in fact, if we could have done that, I guarantee you OPEC would have. And so where we are in oil right now is very challenging. We can release from the strategic reserve, but we are not in an oversupplied situation. In fact, we are in a very tight supply situation in the oil markets and actually across the entire commodities complex for the same reasons. And it's one of the reasons that you just continue to see this pressure on oil prices.